And we've got Tim Kelley from the Montgomery Fund. Gentlemen, good evening. It's a very interesting period in the market. Obviously, we've got thing off that 4,900 point level again and sort of looking to sort of track back up. How are you guys sort of looking to invest at this point of the cycle, and where are you looking the most with all of those sort of factors out there?
Okay, yeah, as you say, there's a lot going on, and it's a complicated market to try and navigate. Our approach is very much about bottom-up stock picking. So we have the luxury, in a sense, of on focusing on things that are a bit easier to understand the merits of individual businesses, the earnings and cash flow future for individual businesses, rather than trying to be a top-down or a macro fund manager who really needs to take a view on economic growth, currencies, GDP, interest rates, and I'm very glad that we're a bottom-up stock picker at the moment, because between China, Brazil, Brexit, Greece, Italy, elevated debt levels and interest rate policies as they are, it's an enormously difficult market, I think, in which to understand the macro picture. But good quality businesses will always be good quality businesses, and they should develop positively over time. So we're investing across a pretty diverse range of names. There's a lot of healthcare, there's IT, there's telecommunications. The financial sector is becoming more interesting. What we don't like at the moment is resources. So we see the rally recently. We see iron ore and oil prices coming up recently. We're not persuaded that that's a good spot for us to be, so we're avoiding that. But we can find opportunities in pretty much every other part of the market.
Mm-hmm. Earnings growth, EPS side and net profit side are still very much under a bit of a cloud over probably the next 18 months.
Certainly, it feels like an environment in which we shouldn't expect rapid growth across the market. It's debt levels have been built up to very high levels. That's great while it's happening. It drives economic growth, and it can drive profit growth. We've now sort of taken that about as far as we can, and for a whole range of reasons, it looks as though growth is not going to be great in the periods ahead, and that makes it, I think, important to choose wisely in terms of what you invest in.
Well, with that, I think we've had a very good start to opening the show. Obviously, we do have 90 minutes, so as I said, please pick up those phones. But we do have someone on the phone already. We've got Brett from Sydney. Hello, Brett. How are you?
Oh, hi, mate. How are you?
Very well. How can we help you?
Mine's regarding Westpac Bank. First question to Tim, at these current prices, would you be buying it? And second question to Gary, technically, does it look like to start to tip the old toe in the water on this one?
Okay, Tim, we'll start with you first then.
Okay, sure. Well, the short answer is we own Westpac in the Montgomery Fund. It's a business that we own for a number of reasons, and at the current levels we're happy to have some exposure. Firstly, business quality is pretty good. I mean, the big four banks enjoy a pretty favourable industry structure. They're a protected species. The better ones are quite profitable, and Westpac we think is one of the better ones. We've seen share prices come down or a long way in recent times, and the reasons for that are pretty well known. We've had the increase in capital requirements. We've had concerns about impairments flowing from the resources sector. We've got concerns about whether there might be impairments to flow from the property sector. We've got the idea that credit growth is likely to be subdued going forward. There's a lot of things that you need to sort of mix into the picture. When we sort of try and balance all of those factors up, we come to the view that all of the grim news is pretty fully priced into some of these bank stocks now. And while it's not really easy, it's not obvious, we think on balance it certainly makes sense to hold the better ones at current prices.
Take him to you. Obviously, there's a different question here for someone like yourself. What do you see of AMP driving out of that sort of range between sort of 550 and 650 that's been stuck in for a year and a bit?
Well, look, if you look longer term at AMP, it's gone nowhere, or it's gone down over a very long period of time.
Yep.
We think that is symptomatic of it just not being a great business. The return on equity that it earns is not much different to the cost of equity, and that means that as long as that persists, it's the sort of business that struggles to grow profitably. Businesses can, any business can grow by retaining earnings, investing them in the business, and generating a larger asset base and larger earnings off that. But if the return that you get on additional capital is not much different to the cost of that capital, then you're not creating shareholder value. And you can see that in a business like this over long stretches of time. The share price really, it really goes nowhere. AMP is on our numbers an example of such a business, and so the current price, it looks too expensive for us.
Yeah, actually a completely different question in terms of how you would look at somebody like Ascentia Group. Obviously, it's in probably a part of the market that not many people look at with regards to where it's obviously located in that media space. It's a firm that has a niche business, I think is probably a way to describe it. How do you value something like this, and how do you look at it?
Yeah, well, the way we value anything is we try and understand the business well enough to be able to project many years into the future what its earnings will be, and really importantly, we try and understand the economics of those earnings. So how much capital needs to go in, and how much of a return do you get on that capital as you grow the business. And in the case of Ascentia, the thing that stands out for us is that it is a really, really good business. It's one of the best businesses listed on ASX to our way of thinking, and it's one that we own in the Montgomery Fund. And what that means is that, yes, at the sorts of PE multiples that it trades on, that's a big number, and you've got to really be careful in your analysis to make sure that is justified. When we do the analysis, we think it is justified, and it's the sort of business that over a long stretch of time, it's got some great growth opportunities. It dominates its niche in Australia, and it's got the ability to grow very strongly, we think, in Asia for a long time to come.
Yep.
Really interesting business. We think it is. It probably got too expensive in that period. Not too long ago when the price was getting up towards $5, but it is a great business, and we think it's the sort of business that you can own long term and expect to do quite well out of.
I came to you to see the reject shop as having turned a corner, or are you still sort of not seeing through the cycle?
Well, yes, it's turned a corner, but the bigger issue for us is that a good management team is a wonderful thing. It can do a lot with the right business, and it can substantially improve the performance of the right sort of business. The challenge is that you really want businesses that don't need good management, because the current management team won't always be there, and it's a really competitive space. So a business that needs to be run really, really carefully is probably not, it's not ideal from our point of view. So even if management have done a good job of turning it around, they're still in a really competitive space. They can't drop the ball, or it's a sort of business that can suffer again. So we would much prefer to invest in things that don't that run themselves, rather than needing to be really, really well run by management.
Yep. So I'm going to start with you, Tim. How you evaluate a company like it?
Yeah, look, sustainability of earnings is a great thing, because that takes away risk, and earnings with less risk is a great thing. The issue for this business, though, is growth. If you look at a long history of the business, it's earnings between 2006 and 2014 really went nowhere, and it's just more recently that we've seen a pick-up in 2015 and then projected into 2016. If you step back from it and look at the economics of the business, over the last 10 years, it's delivered returns on equity between 10 and 12%. Which is not great, and what's happening with this business is it's recently gone from earning 10 to earning 12, and that's what's driven the growth that we've seen in earnings, and that's fine, but that is not sustainable. If the ROE doesn't rise well beyond that, then the growth pretty much stops at this point. And given the history of the business, it's not clear to me that there's a case for expecting that the ROE can continue to grow from here. So without having studied the business in a lot of detail, it looks like you shouldn't be extrapolating this growth trend too far into the future. And on that basis, it's quite hard to get to the share price, or to find value at the level the share price is at the moment.
Yep. The intrinsic value of it picked up. How do you look at a Blackmores at this point in the cycle? Yeah,
look, it's a really interesting case study. Warren, we'd actually spent a bit of time trying to understand the value of Blackmores and come to a clear view. It's interesting in that for a long period of time, Blackmores grew steadily but slowly, and then suddenly we've seen earnings just take off. And that raises obvious questions about how sustainable that growth is. We can see what's driving it. The question is, can you be confident that will be sustained for a reasonable period of time? Because the price that it's trading at, or has been trading at, demands that growth continue quite some way. A couple of observations there. One is, we concluded that it's really, really hard to forecast with any kind of certainty what the business will do. So there's a wide valuation range. We don't like that. We like things where there's a narrow valuation range, and we can see that all of the scenarios are values higher than the share price. You can't do that with Blackmores. It's much more uncertain. But a couple of points that are worth noting. Where earnings sort of come from nowhere, like that, and suddenly accelerate, you need to ask, what's to stop competitors from challenging that position? If the economics of this business are suddenly so attractive, you would expect to see competitors enter, competition become more aggressive. And I think where we come to is that it feels to us as though competition should emerge within a reasonable space of time if this business continues to be as attractive and as profitable as it is. And that means it's quite hard to be confident that the growth and the returns will continue long enough to justify the current share price. So we can't get there on value, but again, we have to acknowledge that it's really hard to forecast, and so you can come up with a pretty wide range of scenarios for this one. Yeah, it's a business that we followed pretty closely in the Montgomery Fund. We did own it and had owned it for quite some period of time and have looked at it pretty closely. What we did recently, though, was to sell out of it, and there were a couple of reasons for that. One is that the share price got to a level where our valuations were starting to become stretched. And the other thing that we saw was that the growth wasn't coming through as quickly as we had forecast that it would come through, and so our valuation started to decline. And the clinical evidence that Evans alluded to was probably the underlying cause there. The first clinical study they did, or the most recently published clinical study, didn't hit its primary endpoint, and that was disappointing. And it appears as though that clinical evidence may be influencing the growth in the therapy. So for us, it became a value versus price question. If it keeps declining, we'll become interested again. But in recent months, we sold out of that one.
Tim, is there anything you want to add on Godfreys?
Look, it's not a business that I've looked at in any detail. It's now a market cap of 43 million, so it's too small for us to consider. What's a little bit interesting about it, though, is that there are broker forecasts out there for profit 2016, 17, 18 for $10 million. Which, if it's true, if it can turn in $10 million of profit consistently in the years ahead, then a market cap of 43 million is too low. But when a business is capped at 43 and it's obviously been having a very tough time, you don't want to take the broker forecasts as gospel. They may be out of date, or the brokers just haven't kept up with what's happened to the business. So it's not one that I can comment on sensibly, other than to say if it does deliver the earnings that are forecast for it, it looks cheap.
Into their long-term profile.
Yeah, a couple of points worth making there. So something like cloud, the Internet of Things, these are very real structural changes. They're going to drive growth, and they're going to drive opportunity and disruption, and they're things that you need to take account of in an investment thesis for a business that's involved in those sectors. But that a business is involved in the Internet of Everything is not an investment rationale. There's a few more parts to it than that. Does the business have a defensible niche, competitive advantage, the ability to make money out of that growth? Because in a lot of cases there is a change, a technological change, and that leads to growth. But there's an enormous number of businesses that fail to capitalise on that. They try and they fail. And on average, I think businesses that haven't demonstrated even any revenue in this case, it's really hard to be confident that they're going to succeed and they're going to find that profitable niche. I think on average most of them probably do not. When there's hype and there's no demonstration of earnings, I think that's a really good time to be very, very sceptical. So understand the structural changes and the technological trends by all means, but that's just the background. You've then got to think about the competitive dynamics within that, and where and whether business will be able to be profitable within that.